as I've said ad nauseum, the missing piece for me very early in my career was actually seeing someone make trades and talk about the trade they're going to trade, take the trade, and see the whole process, as opposed to some guru cherry picking some setup that made them a bunch of money and they're like, hey, look at me. All right, so let's talk about the methodology in action. Now, when I'm putting these slides together, I go to davelandry.com/archives and I actually go to this page, my own page, and I grab archives for the service. So this particular one, if you go back to 12/19/25, you'll see the glue setup, okay? Anyway, we talked about this one last week, and we'll come back to it a few times. There's a lot of lessons here. But it was a nice little Landry pullback. Entry was here, stop was here, also a TKO, trend knockout. Initial profit target was up here. Now, initially, it didn't do a whole lot. It triggered in for days and days and days, began to implode. As I discussed last week, I just so happened I got criticized for this because we were losing money on it, right? And, well, it happens, okay? And sometimes you just get outright stopped out. But in this particular case, biotech was looking fantastic, and right when we bought in, turned out to be a temporary top in biotech, and biotech overall began to implode. So it's very, I suppose, longer term, it's okay to compare yourself to what's going on in the market, but shorter term, it happens, right? And in this particular case, it's like, well, biotech imploded, so why wouldn't my stock implode? And that's the other thing I was kind of thinking about before going live is a lot lately is that you really have no control in all this, okay? You have to control what you can, accept what you can't. It's a serenity prayer type of thing. Yes, you want to make sure you've got a really good looking setup going in. You want to make sure you're in sector that's doing really well. And ideally, you want that market to be doing well too. And as long as the stock trades cleanly and you could justify your setup, last week I talked about sell me on your setup, and I think I used this one as a walkthrough as to why I liked it. And you just have to let the chips fall where they may. Now, in this particular case, it was very hard not to want to exit. Believe me, I wanted to exit. I'm like, screw this. I don't feel like letting it go another $400. Plus, I had a bigger position in other accounts, you know, so it was a lot of money on the line. And it's quite stressful to be in a trade about a week or so, or I think it was 7 or 8 days, and trading days. So about 2 weeks of calendar days, and to stare at such a big loss. But you really have to let the chips fall where they may. Now the stop on this is a little higher than it should be, or based on the price movement. But actually, stop should be all the way up to where the entry is, because it did hit the initial profit target. But anyway, it came dangerously close to hitting that stop, and then it made a $2,800 swing. Now we have a mystery chart reveal. This is an IPO, and it really took off, and then it made the deep retracement. That's a pattern I call a first deep retracement. There's all the parameters. Entries here, stop is down here, initial profit target up here, and it's MDLN. So let's take a look at it. Didn't trigger for a few days, kind of took off after it triggered, but then came right back in. And now it's working its way back to new closing highs. That feed just crashed. So we'll see how it works out. The great thing about IPOs, in fact, I actually have a pattern based on just that, is when you have a new closing high in IPOs, often they follow through. And that's because everyone who owns it is at a profit. Now, for the buy at B pattern, ideally you want the IPO to be a little bit less than, or no higher than, at least $30 a share. Somewhere around $30 is kind of the max on that. Initially, it was a $20 rule. I called it. That's what I called it. But I find that once they're above now $30, the buy at B doesn't work quite as well, and you're better off waiting for the first deep retracement or your first setup or your first pullback, whatever the cases be, or maybe, or however you want to look at that. But anyway, So far, it's doing okay. Let's not start kissing each other just yet. Now, one thing I wanted to talk about today, and I want to flesh out all these different nuances as time allows. But one thing I want to talk about is the fact that your margin equity changes with the money management, okay? And that'll make sense as soon as we walk through this. So in this particular case, this was KGC, a gold stock we're long. It took a while to get there. Now, this is a great testament for following the plan, not micromanaging, and a few of these things will become resolutions, obviously, for upcoming presentations. But anyway, it took a long time to get to the IPT for KGC to get the IPT. Easy for me to say. But then, fortunately, it took off, and we've been trailing the stop higher ever since. Now, if we back up to the beginning of the trade and take a look at it, it was 1,000 shares at like 14 and change or so. So right here, you put up $14,000 in margin, $14,600 in margin, which is a significant amount per 100K. So that's 14.5% of your account in one stock. That's a little scary, okay? But it's manageable. And when you hit the initial profit target, you sell half. So now your margin is down to $8,250 plus you have $1,000 in banked profit. So you could kind of look at it, if you look at it as a whole piece, the whole trade as a piece, you could take that off the margin because you have the money. Now, what's interesting is if you are fortunate, and this is the secret sauce right here. The secret sauce is the money management, the letting that stop widen out over time, and then taking half the profits initially just in case it doesn't. And what's kind of cool is if you get into a stock that's fairly low price, that it doubles like a case like this or more, then you have a sizable position on. So you've got 500 shares. That's $16,000, $17,000 in margin, so to speak, in this stock. Now, 10,000 or 11,000 of that is profits. So depends on how you want to look at it. If you look at the whole piece, you've got $5,000 total risk out there, okay? But technically it is $16,000. So the point I'm trying to make here, or one of the points I'm trying to make here, is that through the money management, your margin increases and decreases. You're taking risk off, okay? But we don't scale after the second low. And in some cases, I will, okay? Like, for instance, there was a crazy IPO. It's now halted. God knows where it's going to open, probably at zero. But I took profits at the initial profit target, and then I peeled off some more shares when it was going absolutely crazy. It's the Lester Love, who I mentioned last week, let them have it, the type of trade. And of course, in hindsight, I wish I'd have peeled off a little bit more, but I thought it was prudent at the time. It was just so much money. Whenever you're just counting your money and you feel like, oh man, I could go do this, I could go do that, or whatever. Well, don't go do this or don't go do that. But if it's something ridiculous over a short period of time, and the numbers were ridiculous on this particular stock, it just went straight up as an IPO. That it's like, I'd be kind of stupid not to peel off a few $1,000s here. This is just a gift horse. And that doesn't happen that rarely. So I really don't have an official plan for it. It's a very good problem to have. And I suppose next time we get in one and it goes straight up and goes up several 100% over a few days or whatever, or whatever, a few weeks, I guess, we might think about scaling out of a little bit of it. But one point, or the main point I'm trying to make here, is that you're taking risk off, but the risk does increase. Open risk, I suppose, does increase over time. And keep in mind that I'm kind of backing into something else too, but keep in mind that open profit drawdowns come with the territory, okay? And Richard Dennis was okay with the turtles having open profit drawdowns, because if you're following the system, you will have a lot of open profit drawdowns And by scaling out, we help to mitigate those a little bit, but they still can be substantial, especially over time. But the point I was trying to get to with this is that sometimes when you catch a stock at relatively low levels and you got on like 1,000 shares per 100K and it doubles or more, then you start to have a pretty sizable position on. And yeah, the open profit drawdown is going to suck, but if it keeps on keeping on, knock on wood, like this one has, and the other gold stock too that we're still long, then you could actually make a substantial amount of money. So if you think about it, this one stock has increased your portfolio. If we're keeping the math round with 1,000 shares per 100K in this particular case, it might be fewer shares if you have a wider stop, or will be fewer shares a wider stop. In this case, pretty serious position, right? Still have 500 shares on, which is still a lot, but you made about $11,000. So that's 11% on your account. And I use the 100K number to keep the math easy. And I also run a model account of my own that's right around that level to show that I do the trades and to feel your pain, so to speak, and feel your elation too. But anyway, so that's the point I was trying to make, that you're scaling off, but you still have a substantial amount of position, even though you took shares off in the long run. Now, yeah, it'd be great if you knew it was going to go up this much and this long, then by all means, just hang on. But you don't know these things. If I knew that IPO was going to get halted and probably go to zero, obviously I'd have cashed out of all of it. Okay, so hindsight obviously is 20/20, and that's a big part of this game, is not getting too caught up in hindsight. And there's a whole science kind of around this, behavioral science, and there's actually a book written about them, and I'm trying to think who wrote it, but it's called The Undoing Project. And basically the point is that you make different decisions in hindsight. Obviously, it's kind of like the Captain Hindsight character my nephew's introduced me to a couple of weekends ago. You know, the building's on fire, then Captain Hindsight flies in. It's like, I would have put more fire escapes on that side of the building, and they need whatever fire suppressors over here. You know, thank you, Captain Obvious, Captain Hindsight. But you will make some different decisions in hindsight, obviously. And that's a lot of trading, is just going back to the original trade, looking at what you did, making sure that the setup was there, the trend was there, the pullback or whatever you're trading, etc. And letting the chips fall where they may. Now, one thing I wanted to address this week is efficiency and inefficiency, okay? And this gentleman wasn't having my performance, but he didn't take these two gold stocks, which inspired me to put the sharpshooting signals resolution, like don't sharpshoot signals. And if you look at the stocks in the portfolio, he said the stocks don't follow through. Well, and he didn't take those two. Well, one's up 70%, one's up 128%, okay? So we've been in these stocks since May. So what's that? 6, 7, 8, 9, 10, 11, 12, 1, 8 months, okay? So 8 months, that's pretty good follow through, triple digit and high double digit follow through over 8 months. That's pretty good. Now, this exemplifies what I'm looking for, okay? I'm looking for an inefficiency in a market, something that's not priced in, okay? And the glue here, obviously, is another case of inefficiency. It's up 40%, and we've only been in it a week or so, or 2 weeks, I guess now. Now, the thing to realize is you cannot beat the market with stocks that don't move more than the market. The HV right now on the S&P 500 is about 12. HV is historical volatility. It's an annualized type of measurement, and I'll show you how little I know about statistics if I go into too many details. But the bottom line is there's a 2/3 chance, or 2 standard deviations or whatever, that the market will be within that range, okay, on an annualized basis. So that's where the S&P is trading now based on the HV. And don't quote me on all this because there's a lot of caveats, but technically from a statistical standpoint, it should be 12% higher or 12% lower. There's a 2/3 chance of it being one of those, okay? Now, you can't predict off of that, but it does kind of tell you what the market did in the past. And if it continues to behave like that, it's going to behave like that in the future. So we have to find stocks that are inefficient, okay? And by the way, whenever I hear somebody talking about money management or something like inefficiency and efficiency, it's like I know that that person gets markets and understands markets. And I would encourage you to fully understand volatility and efficiency and inefficiencies and seek out those inefficiencies, okay? As a general statement, thinner, more volatile stocks tend to be more inefficient, okay? And then thicker stocks, less volatile, thicker stocks tend to be more efficient. But every now and then, an efficient market, especially like on the short side, okay, can make a very inefficient move because everybody just believes the stock is going to go up forever and everything's fine, and millions and millions and millions of people are in it and trading it, and millions of institutions have billions and billions of dollars in it, and then all of a sudden everybody begins running for the door at the same time. Now that's one of the dangers of trading an efficient stock. An efficient stock is that something bad can always happen, but with an inefficient stock, you know it's the devil. You know it's going to move around a lot. You know it's going to be volatile, so you compensate accordingly. Okay. And that's why I wrote the article a while back, or a few years ago, Better the Devil You Know, and that's talking about volatility. And I went on to show that I think you're better off trading inefficient stocks and more volatile stocks, okay? And I think they're actually less risky in the long run than trading more shares of a less volatile stock, because something bad can always happen. Now, you don't just want to rush out and trade something that's volatile because you say, oh, well, Dave said it's going to be inefficient or whatever. You want volatility plus structure, okay? Now, if you take a look at this glue, okay, so you want to seek the inefficiency through volatility with structure. So in this particular case, the HV now is 116, which is pretty darn high, but we'll take a look at it before. But you can see that this stock was in a really nice uptrend. Okay, the percent move was just ridiculous, okay, from down by the lows or whatever. And it was very persistent. You could draw a line through many of the bars, and the bars that don't intersect your line, the majority of them are above the line you're drawing, okay? And that's just persistency, as I preach. That's mathematically equivalent to linear regression. And then you got a nice little Landry pullback / trend knockout, TKO. Now, I went back and looked at the HV was 91 on that day. Now, sometimes, excuse me, once you get close to triple digits in historical volatility, stocks do get very erratic, okay? And like the gentleman said, stocks are erratic. They don't follow through. It's like, well, you will have a little bit of that problem, but if you have structure and you're willing to live, it's like Better the Devil You Know. Again, I better not name anyone, but I ran across some people who have really bad tempers, you know, and or behave a certain way. Thinking to someone in general, and it's like every time they visit, my wife gets upset, and I'm like, well, he didn't break character, you know. It's like, what do you expect? And what's weird is people get in these volatile stocks, and they think that tomorrow, you know, the day they get in it, it's going to stop being volatile, but it doesn't work that way. So you have to understand the behavior which you're trading. Also, you'll notice a lot of times I use these stops that seem kind of wide. All right, percentage wise, I don't remember what this one was, but it's in the portfolio. I think it's going to come up in a minute, and we'll take a look at it. But percentage wise, the stop seemed pretty big, but we compensated obviously by trading fewer shares. People get caught up in the percentage risk, and a lot of people won't take trades. Like sometimes if something's very volatile, it might be a 30% stop, but a 30% stop might be like right here, you know, and obviously, as you can see, that's what it called for. But a lot of people like, oh, I can't use no 30% stop. It's like, well, you don't get no coke, is what I've said many, many times before. But you're compensating to bring your risk way down, or down to 2,000 per 100K, or 2% per whatever your account size is, obviously. So that'd be a $2,000 loss if stopped out. Now, I grabbed the Landry 100 yesterday to show you the HVs of some of these stocks. So here's a stock that has 850, has gained 853% since it was added to the Landry 100 on 4/28. Okay, and you can see that the HV is now at 78. Now, I imagine if we went back in time, it was probably 40 or 50 back then. But you can see the HVs, here's almost a 300% move, 128 in HVs. So these HVs are pretty darn high, okay? Now, if some of these were to trend in a very persistent manner, and maybe that ARMN, because gold's been so persistent as trend, the HV will actually drop off if something is persistent in its trend. So maybe that's why those are fairly low, or not. 40 is not that low. The market right now, just for reference, is about 12. So again, I firmly believe if you want to beat the market with 800% gains, okay, that doesn't happen often, but it can happen, as you can see here, at least in this list is hypothetical, but all of these were put in exactly on the date that I'm showing, okay, on the close of that date, and that's how it's measured. So these stocks have fairly high to very high HV readings, and so you're seeking out an inefficiency, and that's where the money is, okay?